Welcome to the Dividend Talk podcast, episode 136, How to Average Up. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJI. How are you, buddy?
Wow, man, come on. I'm really, really happy. Happy the peppy, as we would say. I mean, dividend hikes, it feels like a hot summer shower. Like you just want to be outside in this dividend rain. And as you can see, I'm wearing my Aholds Delhaize sweater. So I'm really, really happy. But how about you, my friend?
Yeah, you're putting me to shame. I don't have mine. I should have expected it after your video, which was quite nice actually on YouTube, and it's been quite a week. Lots of European companies cutting dividends, lots of European companies raising dividends. So it's been really good to sit back and watch everything that's going on. But we'll get into all that. But is there any earnings? I assume it's going to be Ahold, isn't it? Tell us, give us a little overview of Ahold.
Look, it's really simple. Ahold is really predictable. It made a 2.2 billion in free cash flow. It pays about 1 billion in dividends, 1 billion in buybacks. It had a little bit of money left after that. They've been reducing their share count by 3.5 or 3.6% again. So this means that next year, if they want to do a dividend hike by 7 or 8%, they only need to find 3.5% or something like that in earnings growth or cash flow growth. So for me, this just shows like the stability of this company, the strength of this company. They've been able to pass over the inflation. Actually, they had quite some discounts towards their customers as well at the same time because of the savings program. So they're really not just only saving for themselves, but also for the customers. And this is why I think this company has been doing so well. Specifically in the US, they've been growing about 9%, only 3% in Europe. It shows the difference. It shows probably the state of the economy. Maybe it also shows how much easier it is to rip money out of the wallet of an American compared to a European. That's what capitalism is. For me, it was just a really good, strong earnings report. And yeah, then a dividend hike of 10.5%. I mean, bloody hell. This was above my imagination. And we always say this CEO and this management is for me the example of under promise, over deliver, the UPOT method. We've mentioned it several times, and they just continue doing this. So I don't believe anymore a lot of what they say in their guidance, because it hardly ever happens that they are reporting below guidance.
It's actually one of the things I remember. One of my first conversations with you about Ahold. I remember reading their outlook. Was it in 2020 or 2019? And I remember being a little bit disappointed, saying, "Oh, these guys are not predicting too strong of growth." And you went, listen to me. They always do this. They always under promise and over deliver. And in the 3 years since I've owned them, it has always been the case. So it's one piece of advice I remember from you, but it's I think it's top quality. And I mean, 10% dividend hike on top of the buybacks that they have. It's been incredible, isn't it, from these guys?
Well, the buybacks actually pay for a
Yes.
lot of this dividend hike as well, right? So the share count continues to be reduced. They announced another 1 billion again, and at a market cap of around 30 billion, and expected also to dip over the year, maybe a bit higher, but you just get on average 3 to 3.5% shareholder return, and it's doing this already for the last 5-6 years. So, if you see the share count reduction, I think since 2017 or 2016, it's 20% or something like that. So, if it does another 5 years like that, I don't mind it. I really don't mind it. And if it grows the dividend then with 4 or 5% over that time, I mean, isn't this a nice example of compounding?
Yeah, I think it is a prime example of compounding. I think did we have an episode on it? I can't remember, but Aholds should be the example we give because it is slow. Well, it's not even that slow actually. I mean, you say it's slow, but it's not as slow as say Unilever, for example. Um, I couldn't ask for any more as a shareholder from them, to be fair.
Yeah, and it's the result of a strong free cash flow and a relatively low dividend because they have now 40% payout. I mean, it's 255 EPS. Could have been a bit less. Let it be a 50% payout. So, but if you're like conservative in general in your whole approach, then they have just always room to grow still with this because their earnings are so predictable. And it didn't even spin off ball.com yet, which it doesn't really contribute to the net profit and to the cash flow, free cash flow. So in that regards, there's a hidden gem there as an asset
Yeah,
for an online retailer, e-commerce, national e-commerce player. So we are not even discounting for this and when we think about fair value and such. So I think this company is just top notch in how they run their business. Their digital presence has been always relatively good, maybe not always as good as the startups that maybe have a better experience or something like that. But with their economies of scale, they are able to compete with these guys, and that's what's so nice about it.
yeah. I mean, look, we could talk about these for all episode if we really wanted to. I know you have a nice video giving an overview of the earnings, so maybe I recommend if you want a little bit of a deeper view of it to check out that video. We'll link to it in the description. But we'll move on. We can't always talk about Ahold on this show.
No, so you talk a bit about your engineering favorite darling, right?
Yeah, I mean it's a company that I wish I owned a lot more of, and it's Schneider Electrical. I think I've mentioned these maybe towards the tail end of last year. It's a company that I started to dip my toes into. I think valuation is my problem, but it's a company that I really see strong head or tailwinds for. Revenues this year was up 12% organic and 18% reported. Free cash flow was up 19% to 3.3 billion. They're raising their dividend as well. So it's been a really strong year, and honestly, I expect much of the same from them in 2023. One thing that they are doing as well is they're changing their CEO and they're hiring from within as well. So I've just seen that pop up on my news feed this week. So I need to read a bit more about that. But it's look, a solid company. I think automation is we all talk about artificial intelligence and automation. I think they'll go hand in hand. I really do. And I think Schneider have the capabilities on an industrial front to really lead the automation field. So it's a company that I'm adding bit by bit. And actually I think it's a good topic that we have today about averaging up because I really see tailwinds for this company. So maybe it's a good example of will I average up and what my thoughts around that as well.
Yeah, and I'm confronted so often with Schneider Electric because we have a local Castorama here. It's like the Hornbach, but the
Yeah,
French Hornbach. And every time I go there, I see like Legrand, Schneider, and the other big one. So it's really interesting to see, right? That there's literally a wall full of these light switches. So
yeah.
it has a strong consumer brand as well, and the light switches are just really rock solid. So.
When I hear the name Schneider, I think quality. I see Siemens, I think quality, and I think that's as a European, it's a really strong European brand. It's similar to Rockwell Automation in the United States. Uh, Siemens and Schneider would be the European equivalent, and to me, it screams quality. That's what you want to own, isn't it?
Yeah, exactly. So, well, congrats also here. I believe it had a nice dividend hike, if I'm not mistaken. So,
Yeah, nice. I can't remember is it 10%, but I had a nice dividend hike. So it's it said I only own a small amount because of valuation. But it's a company I really want to. I'm an engineer. Come on, I need to own engineering companies.
yeah, that's true. So I believe, let me check, but I believe Schneider Electric, they hiked their dividend with, let me check, it was Yeah, Schneider Electric hiked the dividend to €3.15 per share, which is 9% more than
100%.
the year before.
Yeah.
So again, a high single-digit dividend hike. So congrats to all the shareholders. I mean, we love these. Simple
Yes.
can be
Yes.
said.
Speaking of dividend hikes, we have a lot to get through. We have a lot to get through this week. We didn't actually put in some dividend cuts. I follow, I don't know if you know, I follow Euro Dividends on Twitter, and they give lots of information about specifically European companies. And it seems this week and even last week, a lot of Scandinavian companies, Sweden, Norway, Denmark, have been cutting their dividends. It's quite interesting. It always seems to be tailored around that, but the rest of Europe seems to be doing just fine. As we mentioned, Ahold Delhaize had 10.5% increase to €1.05 per share. Nestle was there as well. So they, interestingly, you always think of Nestle with Unilever, the direct competitors, and you have one that keeps it flat. And Nestle increased their dividend to by 5.4% to 2.95 Swiss francs. And that's 28 consecutive years for these guys as well.
Yes, and then actually even more when it comes to remain or flat, right?
Yeah.
Where I think about 50 years or 60 years. So for me, just the issue is with Nestle, always when I look at it, their numbers don't look good. Yeah, I don't like what I'm seeing when it comes to debt and these kinds of things. And then when I compare to Unilever is kind of keeping it flat, but I don't have a feeling that Unilever is leveraging up or something like that. So that's the main difference for me between Nestle and Unilever. I don't own any Nestle actually also for that reason. Every time I look at it, for me, the dividend yield is not good enough. The valuation is way overpriced. And then if I look at the other metrics, it just doesn't excite me. Yeah. But other than that, you got to give it to this company. What they also did, was it with Starbucks deal and such? I mean, they are really, really clever cookies there in Switzerland.
Yeah, they are. NN Group, a company that I bought in January of this year, they're a Dutch insurer. They actually increased the dividend by 12%. I was not expecting that, to be fair.
Kaboom, right? We say nowadays on Facebook, kaboom, with these
Yes.
hikes, because that's the only way you can respond to it.
Yeah. As I said, a little bit unexpected, but to be fair, maybe I shouldn't have. They have a really strong history since they've spun off. So it's quite interesting. We have another one. Is it formerly known as Reed Elsevier RELX?
RELX, yeah, it's a
RELX.
direct competitor of Wolters Kluwer. We've been talking about Wolters Kluwer in the past. RELX is also having the same business model, and they are increasing their dividend to 54.6 pence because it's UK listed, which is an increase of 10%. So also here again, a double-digit hike. But what about Teleperformance? This French company that's doing all these call center services. A really, really high growth company at the moment. 16% up, almost 70% up to €3.85 per share. For me, this is actually a really, really attractive company that, together with the Kleine Kapitalist as well, I've been looking already into several times into this one, and definitely on my radar. Definitely something that I could consider actually, but I just lack the time so far to do more homework about this one.
Cool. Call centers is always interesting. I worked in one. I spent 5 years of my life inside of one. It's not an easy job, let me tell you. it's
Yeah,
not
but they have a
job.
specific business model. I think they also do some automation and such. So it's just, I think, pretty well run business.
Yeah, of course.
Then we have Vopak, which is an oil. How do you say that? Where you store all the oil storage provider. They increased their dividend by 4% to €1.30. Also here again, they have a really, really solid dividend growth track record, and I'm really impressed by this one. I know it's just 4%, but in times of these where oil is being sold a lot, these businesses naturally don't do so well. They do better at the bottom of the cycle because then oil's too cheap and everyone wants to store it to sell it later at a higher price. Yeah, so still being able to do this and pull this off for me is quite a demonstration of solid management.
Yeah, Coca-Cola has raised it for the 61st time. That's 61 consecutive dividend increases these guys have got. It's a 4.6% increase to 46 cents per share. Not as good as Pepsi. We know we always compare Pepsi and Coca-Cola, but I still think it's in this environment. I think it's a decent raise from Coca-Cola. I know there were some issues around Pepsi around their free cash flow. Is it covered? I don't know if that's the case with Coca-Cola. I think they're covered a little bit better here.
Generally, Coca-Cola, I think, is in a better position a little bit at the moment than Pepsi. But Coca-Cola just 2-3 years ago was in a really, really tough situation as well with the hikes. So I guess it's really always a fine line for these kind of companies because they are such stable growers, but at the same time, like consumer trends are not always favorable towards soda drinks. So, but still, therefore, really, really impressive how and they are already so optimized as a company, and they're still pulling this off. It just shows about the quality here as well. Again,
of course. Sherwin-Williams hikes their dividend for the 45th time. Their dividend increase it's a little 0.8% to 0.6 cent quarterly. I mean, what's the point?
Well, stability, 45 years.
Know.
I mean, we need to give this company kudos. But then we have a dividend. Well, let's say a company that pays out always a percentage of their EPS and is not so much committed to growing dividend, but still worth to mention is just because it's this company, but Heineken did almost a 40% dividend hike to €1.73 per share. So this is more like if you just want to own Peter Lynch stocks, so own stocks of which products you use a lot, then Heineken could be consideration, but don't count on their dividend growth over time, over the many, many years, yes. And if you really zoom out, maybe from the cosmos, but when there is a crisis, they tend to always cut their dividend because they preserve cash and they have a different policy here. So
yeah, I mentioned the company last week when we spoke about the German stocks. It's probably best to buy them in a crash, and Heineken is probably something similar. When they cut the dividend, which will happen, it's probably a good time to buy them after that, because then they'll start growing. But I would much rather, I mean, look, it's nice when you see a 40% dividend hike, but realistically, I would rather see that as 6 or 7%, and they continuously do it.
Exactly. That's what I like as well.
I would much rather that. So, as you said, it's a company I would like to own, purely for the brand, and as you said, it's used quite a lot, but the dividend is too unstable. So, no can do. We're not really surprised with the next one, Realty Income. I think is it 101 quarterly increases at this stage.
Yeah, it's insane. But again, a dividend hike. So I mean, will it ever stop? It
has to.
Yeah.
Nothing can go up forever.
Although I do believe they are increasing the risk with their business model by going international. Totally different market.
Yeah.
But still lots of appreciation for that company, and I love owning it. And Cebus, the other monthly dividend stock in real estate in Europe, I think it will be reporting next week or the week after. So in the upcoming 2 weeks. So I'm really curious about that one, how it's doing with their debt, because otherwise I will load up a little bit more.
It's an interesting thought, isn't it? What would happen, Realty Income, if they could not pay the dividend, or if they even kept it stable for 1 quarter? Heaven forbid. But I mean, look, it can't go up forever, or can it? And then the last one we have on our list is ticker symbol FIS, Fidelity National Information Services. Hiked its dividend by a nice 10.6% to 52 cents per share.
Yeah, again, double digits. I mean, look, these were the dividend hikes that we selected for this week. There were still a dozen of more. But what I think is important for specifically listeners that are relatively new towards dividend investing, guys, if you hear this, you just heard us in giving you 12 to 15 stocks that are dividend growers, that have a history of dividend growth, all giving you a salary hike. And that's the simplicity about dividend investing. You buy them, for instance, at a 3% yield when you have the opportunity. And most of these you can put on the shelf. We are passionate. We study these companies continuously. But if you buy them, of course, we always ask you to educate yourself about stocks, know what you own. but they are just giving you every year almost salary hikes. I mean, how easy can an investment strategy be? And then I saw on our Facebook group someone saying like that a banker was recommending to maybe not do it because it's quite dangerous. But what, and I understand this, the first time when you're investing in the stock market, everything feels dangerous. But for me, this is one of the most conservative investment strategies that you can imagine.
Yeah, I mean, between this and ETFs, I can't think of any more a conservative strategy. Buying a house is risky. Everything is risky. We know there's risk involved,
Yeah.
but I mean, there's history there. It's proven. You select a couple of good companies, let it sit there for 20. Easier said than done when you're like us and you analyze all the time. But if you just shut everything off, go log into your account once a year, buy some companies, log off, you will.
Yeah, I think you'll really do well. So I hope these dividend hikes also inspire you all, guys. I mean, for us, it's like carnival seeing this all. So all the tickers will be in the description of this podcast if you want to look it up. I can imagine that sometimes our accent or specifically Derek's dialect here makes it harder to understand, but all the ticker symbols will be in there so that you can look it up yourself as well.
Perfect. I think it's a good time to move on to our conversation about averaging up, and I think it's a really good conversation. We get this all the time, and sometimes we speak about it as well, being price anchored to a company. I had it with Microsoft, for example. I mean, let me ask you first: what do you prefer, averaging up or averaging down?
Oh, okay, so that's a really hard question to answer, but I prefer averaging up, and the reason for that is if I'm averaging up, it means that I'm convinced about the quality of the business, and that it's still worth paying more for what I was paying initially. What I find easier, 10 times easier, is averaging down.
You see, right? So you say you prefer to average up, but if you listen to our episodes the last 6 months, right, and we've crashing, we're happy. We said we've been praying for a crash. We want the crash. We want the stock market to go down because we can buy our companies more cheaply. So what is it? Do we want it to go up or do we want it to go down? It's really hard. I know in theory, in your mind, you would like to see it go up. Yeah, look, we're human. Everybody loves logging into their account and seeing it green and everything going up. I mean, I think that's a natural thing. I think all the news has this program to look at the share price. But really, I prefer averaging down because I can buy more. That's what I would prefer.
This is also that because we're dividend growth investors and value investors. So when for us the price goes down, we get a better yield, hence more passive income.
Yeah.
I remember in my early 20s when I was playing a bit on the stock market, not knowing what I was doing, I didn't want to buy companies that were in the red. I only wanted to buy them in the green because if I would buy one that is 1% down, I'm losing money.
Yeah.
So we need to realize that as dividend growth investors, we are so differently wired than all the pundits that we see on TV that are effectively day traders, but saying to us that they are long-term investors. Yeah. So we have this kind of sick, awkward thinking here that we have inherited with dividend growth investing. Yeah. But for me, averaging up is just so hard. You mentioned already the price anchoring. So, for instance, when I bought, let's say, Microsoft in the low 40s, and then I saw it going to 100, like in a matter of a year or 1.5 years, right? And I felt like, oh, I missed the boat. So, but then when it went back to 80 or something like that on a dip, I bought more again. But why wasn't I buying at 60? Why wasn't I buying at 80? I remember that I didn't want to buy at 40, 45 because I wasn't entirely sure yet how this would work. Satya Nadella was not so much mentioned. I mean, he was talking about the cloud, but it was not in the numbers visible yet. So I want to see confirmation, which is for me normal. I don't want to straight away go full position in half a year. But then I should have known around 60, 70, and because it was already in the numbers there. Why wasn't I averaging up, right? I'm still asking this myself. So I then it went to 100 and I bought it on the dip to 80. Why didn't I buy again at 230 the other day? Yeah, it was not like it was too expensive. I know why. In this case, it was the yield. The yield was
Yeah.
just too low.
Yeah.
But there are other stocks as well where I have this issue where it's really, really hard to average up.
Does it come down? I'm going to use a phrase that really bugs me on Twitter, particularly during the growth phase. But is it because you did not have a high enough conviction? I mean, we hear this high conviction stocks, right, and whatever. But I sometimes feel that I don't average up because my conviction is maybe not as strong as what it should be. And then I look at something like you said, we are value investors. I see something that looks a little bit more undervalued, and I turn my attention to that instead of
Yeah.
focusing on maybe a singular company.
Yeah, I think that's also, but there's maybe also an element of yield chasing in it, if I'm honest.
Yeah, I agree.
I want to also have a decent yield here, and then, for instance, if I have my border at 275 and it was 3, and then it becomes 2.5, even if the company is still not too expensive with a decent multiple, it's hard for me to buy a company at that one. Specifically, if I knew that it traded at 3% 4 months ago, I would rather wait and just cross my fingers that it gets back to 3%. And often this actually happens. So over time, I've also learned that. But yeah. It's just so it's for that also really difficult. But I must say, I'm now like 8 years down the road almost with investing, and 7.5. I am getting better in it. I'm really, really getting better in it, and averaging up is not so difficult anymore as it was. It's still deep in my mind is difficult, but I started building a bit of a system in it, a mental model in it, which kind of allows me to easier average up.
What I find a sticking point is, and it's probably a reason why I stopped doing it a little bit, is, like, you value a company, okay, and
Yeah.
everyone uses probably the same templates from online. They're using dividend discount models or discounted cash flows, and let's be honest, I didn't go to finance school. You're making a lot of assumptions in both models, but when you make those assumptions, you get anchored to a price, and you get, okay, so Microsoft, I have a fair value, and I think I had a fair value in them on about, was it 120 or something? But because I went through that exercise of valuing that company and making those assumptions, that's what got me anchored to that price. So when they went up, I felt it harder to buy that company because I felt like their value was lower. So I think for me, I try to keep it a little bit more simple now. I still do them, but I look at ratios a little bit more and compare them to their peers, and try not focus so much on value. I do want them obviously not to be completely overvalued. I'm not going to buy them with a PE ratio of 30, for example, or 40, but I think dividend cash flows or discounted cash flows and dividend discount models anchored me to a price a little bit too much.
So I disagree myself a little bit with that, because what I see there is more like the fear of missing out that many people have. Because honestly, like with ASML, I've got, I don't know, a target price of around €600. It has been trading a lot below that this year. I'm using their 20% annual growth rate over the next 5 years. So for me, it is not so much about the price anchoring. It's more like if, for instance, the share price is going up and the free cash flow is even growing less than I estimated in that for a high growth company, it's for me just not worth buying. It just means to me that there's a certain hype in this stock, but I get a really low yield in return. The free cash flow is not growing enough. So that means in general that there will be less room to grow the dividend over time as well. So I understand that, yeah, but in a zero interest environment that we have seen, and we're still historically seen at really, really high multiples, I don't feel that it's needed, specifically not if we have enough alternatives. And I'm talking here about the L'Oreals of this world,
Yeah,
right?
of course, yeah.
It's for me not, even if I model it with a 15 or 20% here, then you hardly get to the current share prices, and then you also need to consider, will they continue hiking their dividends with this fast if you take a low yielder? So for me, I feel very, very comfortable with my discounted cash flow methodology for that reason, because it does support investing in growth stocks.
Yeah.
It's just more the assumptions, like you said. If you are always conservative in your assumptions, then that's another one. But I find myself putting an ASML 20%. I don't find that conservative, to be honest.
Yeah. I mean, everyone's going to be different. I'm just talking from my personal experience. I feel like that anchors me a little bit too much, and I try and not be. But you spoke about ASML and L'Oreal. We don't own L'Oreal. Is there examples of companies you do have that you do not regret averaging up on?
Oh yeah, for me, one of the most classic examples that I've been averaging up on all the time is Johnson & Johnson. I bought it at 110. I believe at 100. Then I believe at 115. Probably again at around 125. And I just bought them again at 161 last week, a little group. And for me, what has been helping me here, and I come back to my valuation model, I know kind of what the price is. I kind of know what the yield is around that price. So now, if you think about it, if I know what kind of fair value is, I don't think anymore I don't anchor myself anymore towards my last buy. I anchor myself to that price. So what helps me, whenever it dips between 160, I'm free to buy. And it doesn't matter whether I bought it last time at 115 or 125. Yeah, and if it has more than 2.75% yield, and I know it will be able to grow its dividend for the next 10 years, this is really what dividend growth investing is. So what I need to do is the price anchoring is not helping us as dividend growth investing. Dividend growth investing in its pure form is you buy a stock that has all in it to grow the dividends. And that's how your passive incomes grows. So share price is actually irrelevant. If you have a plan that you want to, let's say, to retire early, you need to have a average yield at purchase for 3%, and it needs to grow 6% on average. The only thing you need to know is, am I paying now 3%, and can it grow 6% on average in the next 10 years? If it can do, in its purest form, then that is already enough. And you don't need to look at the price. Of course, the yield is a result of price, but you wouldn't need to look at the price. You need to look more at the ratios. Is the dividend safe? That's the only other question you need to ask. And with that, you pull yourself out of the price anchoring. And that's what I've been trying to do with this. But still, because I have this value mindset in me, I only don't want to overpay for things. But it has helped me. If you ask me how I've been successful in these kinds of things, like Johnson & Johnson, it has helped me in that way. And now, for instance, I upgraded my Ahold from 25 euro to 30 euro after last earnings. So now I know at 28 or 27 euro, because then I get a little bit below fair value, it's then yielding around 3 to 4%. I will be buying because I believe the stock continues to grow, while my average price is 20 euro or 21 or 22 euro. But I will be buying because I believe in this company for the next decade.
Yeah, taking the share price out is a good piece of advice. I mean, 6 or 8% return, whether that's in share price or whether that's in dividend growth, it's the same thing. You don't need the share price. Everyone gets caught up in tracking the S&P 500, and you have to get total returns, including the share price. No, you don't. Your total returns can come from dividends and dividend growth, and it's something I'm trying to focus on. I'm really starting to focus. I said to you on dividend growth this year. I did an exercise and went through my last 4 or 5 years, and my dividend growth was hampered by the likes of AT&T cutting itself, and had Tanger as well, but it would have been in around 5 to 6% without those. So it's dividend growth for me is important. Getting away from the share price is something that I'm trying to do more and more, specifically this year, trying to focus more on dividend and dividend growth, not the share price.
And this is also actually where Alan inspired me. Alan is our buddy on Twitter. He's from Sweden. He just thinks like, is it 5% yield? Yeah, high yield. He is a category of high yield. Is 5% yield? Does it have like 10% dividend growth track record? I buy it. Who cares? Yeah, and he owns more than 100 stocks. Sometimes there's a cutter. He sells it, yeah, for instance. But if you look at his portfolio yield, it's, I think, almost 6%. He's almost retired, yeah, early with this process. And he doesn't care about all this other stuff. And he really inspired me with that, like, okay, sometimes I need to take a step back here and just trust on the companies that I own and trust that if they have a history that they can do it. Of course, we are proven sometimes wrong. But if you have like 120 or 160 companies in your portfolio, like him, he just built up a really huge ETF from that point of view. And yeah, if you're then your biggest position is 1.5% and they cut the dividend by 10 or 20 or 30%, you hardly feel it. Yeah, but if we see his dividend growth over time, it's amazing. It's simply amazing.
Yeah, I mean, to be fair, he does share his progress with us over time, and it is quite inspiring. And sometimes we've had the conversation: are we doing the wrong thing? Should we just take his mindset and go with it? But I mean, there's definitely different ways to look at it. Dividend Hummingbird seems to do something similar on Twitter. Just buys loads and loads of companies. Probably has a portfolio of maybe 100 different companies, and it can flatten the impact of a cut. So, for example, an AT&T cut for me was huge because they were a big part of my portfolio. But someone that has 200 companies with AT&T in there would probably hardly feel that. So it's all about mindset as well, though, isn't it? It's how you feel, how you manage. I would probably be uncomfortable owning that amount of companies, but then again, I probably would not have to put in as much time with that amount as I do at the moment. So.
And tell me, is there any stock or stocks where you have been averaging up, and how was that for you?
So I average up on quite a few. So I average up on Texas Instruments quite regularly and Johnson Johnson. So I try and add 1 or 2 shares of them a month, purely because, and the reason why I do that is because I know these companies when I look at them, and I always think that they're premium priced because they are premium companies for a reason. And I have that fear of missing out on those types of companies. So that's my strategy with that. I've seen someone like Russ do it with Pepsi, 1 share, was it a week for 100 weeks or something? So it's not quite like that, but I definitely do buy 1 or 2 shares of these. I want to try and do it with someone like Siemens as well, because I really like Siemens, and I'd probably throw Schneider Electric in there. So I'd probably buy maybe 1 share each every month or 2 months on those.
Nice one. Well, hey, for me, this is always a really important topic. There's a lot of psychology involved with averaging up, but I hope that the listeners at least heard and understood a little bit how we are approaching it. As you can hear, we are not perfect. We are as human as it can be. But by sharing these stories, I really hope that our listeners also understand a little bit, like at least how we think about it. And maybe they get inspired about it. Maybe they think like, guys, thank you. I actually even know a better way. Share it with us.
Yes.
It's never easy. But I do know that this is something that's in many of our minds. So I hope this was really a useful topic for you as well as a listener.
Perfect. We'll move on to a portfolio review. So I had a guy on Facebook, Steve, reach out with his portfolio. And luckily, he's based in Switzerland, so he has access to all these good ETFs that we give out about so often. But just to give you a feel for some of his portfolio, his largest positions are in some of these ETFs. So you got ticker symbol VOO, it's 15% of his portfolio. Ticker symbol VOT, which is 13%, and ticker symbol VT, which is 9.61. So they're ETFs. And in some of the stocks that he owns, then you've got the likes of AbbVie, ticker symbol ABBV. He's got Ahold Delhaize in there. He's got 3M. He's got Cisco, and he's got energy company, ticker symbol ATO, which I think is Atmos Energy as well. Also Texas Instruments and T. Rowe Price. What's your initial thoughts looking at the portfolio?
It's a pretty well composed portfolio, I would say. I see some really classic dividend aristocrats in here. VOO and such and VT these Vanguard indexes, I don't see them necessarily entirely as pure dividend growers here. Yeah, so maybe that's a question, but it gives you a lot of diversification. It's easy to buy. I do see there, for instance, AbbVie, Cisco, 3M, and I'm just wondering, like, what I'm missing a little bit in this company is stocks from the information technology sector. I know Cisco is in there. It's probably the only one, if I see this well. You could say Texas Instruments also, but I'm missing a little bit this. I know these are hard to buy, but I feel like this is really, how you say it, an important industry sector in the upcoming 10 years. So what I would say in general, and I expect this probably to be on his watch list, but really have some of these IT stocks on there. So when the time is there to really buy some, that would be me. Because I think all the companies there in general are good. Typical classical dividend growers, a mix of US and Europe. Many of us have 3M in the portfolio. We know it's going through a rough time. It's not his biggest position. So for me, it's like, yeah, normal to see this in someone's portfolio, right? It's not something you sell straight away.
So when I saw this first, my very first reaction was, one, I was jealous of the ETFs, but my first reaction was, this is playing it safe. It's a very, very risk adverse portfolio to me. I don't see, apart from say Walgreens might be a turnaround play, but for me, it's someone that is very cautious in their approach, and I completely understand that. I think it's well balanced. I do like what he's got with the ETFs in comparison to the shareholding, and even from our brief conversation, it didn't say as much, but I get the feeling that maybe he's not as far along in the journey of being comfortable picking individual companies. And I get that sense of feeling by these companies. I'd like to see a little bit more riskiness in there. You only live once, but a couple of high yielders. And as you said, IT, information technology, I think is important. But overall, I think it's a strong, well-balanced portfolio.
I don't think that he will see really quickly a dividend cut. If you think about from a passive income point of view, he has a really, really defensive portfolio that should do him really well in the upcoming years.
Yeah. No, I think it's a great defensive. I think it's a great defensive portfolio. And as you said, from a dividend perspective, I think there's good dividend growers there, and I think it's pretty safe. So I think it's a good portfolio. I really do.
Yeah. Good. Thanks for submitting it, Steve. We always like these kinds of things because actually we learn probably more from the portfolios ourselves than maybe the listeners do. Okay, but talking about which, let's go to some of the listeners' questions. And the first one is from our friend who is our driller, Mr. Drip. And he is having a specific question to you. Is it true that Apple, Meta, and Google are forming a government coalition in Ireland?
I mean, let's face it, companies don't pay tax here in Ireland, so maybe they already own the government. No, it's not true, but that's quite funny.
Okay, then the next one is from Maciej Macievich, and he's asking, if you were starting to build a dividend portfolio now, what companies would you consider first for the portfolio?
Honestly, let's go back to Steve's portfolio. I would probably pick 90%, 90% what's on that. Listen, my brother is starting this journey as well, and I never give individual advice or tell him what to buy, but I'd always say, look, if I was starting, Johnson & Johnson would be up there, Aholds, Delhaize would be up there. Who else would be up there? Microsoft would be up there. Companies that first of all and that are pretty well stable. So that's where I would start, to be honest.
Yeah, same here. AAA balance sheets, Microsoft, Johnson & Johnson, maybe even some Apple because of that. I know they're really low yield, but just that you can say that you have them in your portfolio. I would definitely go for the consumer staples as well, because those are the ones that you really start appreciating dividend growth. And we've seen it with Pepsi, Aholds, and the likes. Maybe a Target, these kinds of things. And then I wouldn't buy any energy at the moment. I would
No.
really buy them at the bottom of a cycle again. And you don't know when the bottom is, but you do know when there's stresses in the market that you know, like, okay, we're now in another phase than where it is now.
Yeah, I would definitely in the beginning stay away from cyclical industries.
Exactly.
All
So
kind of cyclical.
industrials,
Yeah.
energy, I wouldn't touch in the beginning. Really like a defensive first.
And I go back to my brother. He Johnson. I think he owns more shares than them of me right now. But he also said now he's looking at Beatrice, and I said honestly, I own them, but you're only beginning. It might be
Yeah, it's not a good idea.
it might not be a good idea, and I wouldn't
Mhm.
tell him not to, but I'm trying to guide him. So if you're listening, do not invest in them. But I mean, for me,
There's too much risk in that stock for a beginner.
exactly.
I see it as deep value.
Yeah,
However, there's also associated risk, and the you should first have a foundational core in the ultra safety dividend stocks, and that's why you need to look at ones with the best balance sheets in the beginning. I know the dividend income might be a little bit lower, but you build this sense of security and really appreciation to dividend investing.
nice. Chicago Blues has asked, how would you rate a portfolio of pretty much ETFs? So you got the Spider US Dividend Aristocrats, the Fidelity Global Quality Income ETF, and the Van Eck Morningstar Developed Markets Dividend Leaders.
I would call that the happy life portfolio. You can automate this entirely, and you never need to look at the stock market. You never need to look at your broker. You just set up the rule one time from your bank, transferring the money to the broker, and then you automate that as soon as the money comes in, and you open up your portfolio after 15 years, and you start living off it.
Yeah.
That's how I rate this portfolio.
And you have 1% left over to go mad.
Yeah, exactly. You know, I don't know if everything will be here dividend growth. So that's why and we don't have access to some of these ETFs either. But I would only maybe check, are these really growing the dividend year by year, and can they continue to do so to be serious? But generally, that's the beauty of ETF investing. I mean, he has 3 ETFs here, equally split. I mean, then you don't need to be, you don't even need to be following people on Twitter around investing. I mean, why be distracted at a certain moment that you find yourself 5 years later stock picking because everyone was doing it around you and you get inspired by that? No, please don't do that. Yeah.
I mean, if you have a portfolio of ETFs like this, you could just do what my wife does.
Yeah.
Do you know what I mean? Don't pay attention to anything. Log in once a couple of weeks.
Yeah.
Buy it,
The best
log off, and go.
Best advice we can give Chicago Blues is, like, please unfollow us on Twitter. Please unfollow anyone that is tweeting about stocks and all this kinds of stuff, and focus on following jazz magicians or blues magicians, and because the worst is that if you really want to have this portfolio, the worst is that you start falling in love with stock picking because he sees what we are doing and thinks like, oh, maybe I should do this as well.
I agree. Read The Simple Path to Wealth. It's a good book, particularly for ETFs as well. I think that's a decent book. Okay, Mind, I guess, has asked us, in England at the moment, in the UK, banks are given 4 to 4.5% interest on your savings, fixed for 1 year. If you put in 10k over 12 months, you get £400 in profit. How do you find the motivation to search and invest in stocks with a safe 4% yield?
Really easy. We have lived in the last several years at a 0 interest rate environment. That is now 4 or 5% is not pulling me off my strategy. You know, that's the thing. You have a plan and you need to stick to your plan to get there. And also, of course, let's say you buy now a stock of 3%. In a few years, this will be about 4%, right? Because of the dividend growth. And you don't know this about interest rates. You could argue, well, but then I buy it in a year from now. But maybe in a year from now, those stocks are not yielding 3% anymore, but 2%. So for me, this is a question about opportunity costs. But it's also it's also a question that suggests timing the market. Yeah, to me, from a portfolio point of view. And that's why it's so much more important for me to stick to my plan and I don't have any of this at all. For me, money on the bank is not working for me. Someone does something with it and pays me a bit in return, but it's not working for me. My portfolio, if you count all the employees together, there are a few million people working for me on a daily basis. I much rather believe that those people will continue growing my wealth than that a bank does. Bankers are wankers; they don't care about us.
I mean, I've got two easy reasons how to be motivated. And first of all, 12 months, that does nothing for me. And the yield of 4 to 5% does nothing for me either. If you were to say to me, okay, a bank is going to give me 10% over 10 years, okay, you have my attention. Okay, it's guaranteed money.
And
But
then you can reinvest it.
and then you can reinvest it. But this is a 12-month time frame. The yield, I actually expect to beat that with dividend growth and dividends. I expect 8% or more. So I prefer not to go there with the banks. And as you said, 12 months is too little. And I don't live in the UK, so I don't have access to this anyway. So it's another motivation.
Yes, exactly. Okay, good. Hey, and then Tim N is asking us whether we are not sick yet of the terms laser focused, and can you provide some more color yet?
No, how could we be sick of Pat saying laser focused? I think it's funny, and it's always. I mean, look, I work in corporate as well, and there's always certain buzzwords that is always used day to day within your company. I'm sure you're the same. And obviously this is what they use in Intel, and it's probably something that they're trying to reiterate to their employees and to everyone. So he just keeps using this phrase.
But
I don't mind. I really don't mind.
yeah, but I find it really funny to read the earnings reports because we moved the corporates. They moved into a situation where, whether you had a poor strategy or not as a company, as long as you put something on a shelf, people will buy it. Yeah, like there was so much shit money around, so they were continuously growing their earnings, and they could do whatever they want. But now the consumer got a little bit more sensitive to prices and everything, and suddenly they noticed that. Suddenly all the CEOs are mentioning in their reports like, we need to be laser focused. We need to be laser focused. Yeah, it is a bit of this buzzword that is in a hype, and I have a little bit what Tim N says. Like when I see laser focus now, I start thinking like, oh, there we go again. Can I take the CEO serious? Can't they find another word for this?
Yeah, I mean, look, there's always buzzwords pop up every now and again, but once the main content of the report or what the CEO is saying is genuine, I don't mind. I don't mind the odd buzzword thrown in there. But if you're using that to try and turn a blind eye to stuff or put the shareholders off, that's when I have a problem.
Yeah, exactly.
And Caspar, last question: how to force myself to consistently buy stocks every month with these high prices?
So he says two things here that are important: consistently and every month. Automate it. Then go to Trading 212, create a PI. That's a European broker that allows you to do that. I think this, I don't know if IBKR Interactive, no, they can only do fractional shares. No, but Casper, if you're really with that, just automate it, because then you don't have this issue anymore. I'm buying every month. I'm buying the Noble 30 PI on Trading 212, just a few bucks. But there, I don't look at the prices, and I know what the average yield is of the PI, and it works. So if this question is like it's too high, so I don't want to buy those stocks, yeah, then it's different. But still, I would say even that in 2021, when prices were at the top, we were able to find stocks that were still doing well for us. So it just requires you to spend a bit more time on searching.
Yeah. We do have a couple more questions, actually. One of them is from Ivan. From the aging and overweight population, do you prefer Stryker or Zimmer for a long-term dividend hold?
I prefer Stryker because I feel that this is a more high-quality business. It's a company that competes with the likes of Johnson & Johnson with their medtech business, a bit of Medtronics. So yeah, I would go for Stryker.
Yeah, I'd probably pick Stryker too. I think they are a top quality company. It's actually a company I would generally like to own, but the yield is always too low. That's my issue with these guys. And then the last question is from Jesper. This might be a terrible question for your podcast about dividend paying companies, but do you ever look at companies with no dividend like Berkshire Hathaway or AMD? You're right. It's a terrible question.
Yeah, it's a terrible
I'm
question,
joking.
but it's spot on. And I do have a few non-dividend paying stocks in my portfolio, like Google, Meta, Alibaba. And honestly, I would love to at least have one share of Berkshire Hathaway, but
Yeah.
not the B shares. I think it's the A share for what is it, $300,000 or $400,000. But I'm not a multimillionaire yet, so yeah, it's a bit out of my league.
I always love how you're a dividend investor, dividend growth investor, but people think you can't or shouldn't invest in other areas. Generally, you can, but it'll just be a smaller percentage. It's not your main part of your portfolio. So I think it's a perfectly fine question, and I'm like you. I would love to earn one share of Berkshire. I think they will pay a dividend, but not until Warren is not with us anymore.
Yeah, and this can be anytime soon. So I don't think it is a question of having too much patience.
And I think that's a great way to sign off the show. I mean, thanks to everyone for the questions, the portfolio reviews, and we hope you enjoyed this topic. So we'll talk to you all soon. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.